Hi dreamers! After my last video showing my enormous increase in dividend income for August, some of you had a light bulb moment. It's like, wait a minute, she's been showing us what she's been doing, but what has she been doing again? Well, basically, I've tried to take advantage of some of the extreme ups and downs of the market this year and at the end of last year to sell higher on lower yielding assets and buy lowish into higher yielding assets, while still avoiding super high yield and higher risk options that have a lower total return over the long run, like JEPI. Keep in mind, I've not touched about 90% of my portfolio list at all. I've just been monitoring what's been on the fringe. I've also reduced a lot of my non-dividend producing or low dividend income assets, like SHOP and CRM. So today, I'll continue my rotation thinking. I'll show you some of the higher quality stocks that have had drops year to date and could be candidates for buying, which ones I might target from this list to buy, a few I probably will avoid, and one stock that I actually recently liquidated. And at the end, even though I'm a private person who wants to remain anonymous, I feel compelled to reveal something highly personal due to the events of this week. So let's start with the stocks on sale. So today, I curated a list of about 15 targets that I've been thinking about. I also asked my followers on Twitter what were some stocks on sale that they were thinking about. And some of the ones that came back included BNS, Realty Income, Intel, Medtronic, and BLK. So where there was crossover, I included them on this list. So starting with ADP, you can see the yield currently is about 1.74, the beta is 0.8, and you may be thinking, now wait a minute, it's not down at all this year. But I wanted to include it on this list because it's a fantastic stock that, as you can see here, has just been going up and to the right for the past 10 years. And until recently was a bit down year to date before experiencing a surge and now a little bit of a dip. So ADP has been one on my maybe list for quite a long time. And it's one that I'm going to be monitoring to see if it dips just a little bit farther. The next one is Leggett & Platt, a dividend aristocrat with 28 years of consecutive growth. Here you can see in May of 2021, the stock price was around $58 and now hovers around $38, so quite a decline. They specialize in bedding, furniture, and even flooring. And although a dividend aristocrat and on many dividend investors' lists, this business really hasn't been that interesting to me. But if it's been on your maybe list, this might be a good time to consider picking it up. The next one is Realty Income, and it's currently at a 4.45 yield and down about 6% this year, recently becoming a dividend aristocrat. Now you can see here they've recently experienced this drop down to $66.79. Might be an opportunity for investors to pick up O at a little bit of a discount. Let's move on to Clorox. It's a solid company, very boring, which I like. Currently a 3.24 yield, a very low volatility, very low beta at 0.2, and is down about 15% year to date. But with 44 years of consecutive dividend growth, it's often a dividend investor favorite. But check this out. In July of 2020, you would have paid around $240 a share for Clorox. And today, that's dropped about $100. So is Clorox near the bottom? This is one of those stocks that really falls under the category of pandemic stock that rose a bubble of excitement and attention and then has cooled off over the last 2 years as excitement and sales have cooled down to normal levels. So again, if this has been something on your maybe list for a while and you're willing to long-term hold, it could be a nice 3.25 dividend yield for a long time. Let's move on to Ben. Ben has a nice 4.4 yield right now, a beta of 1.2. It's down about 21% year to date and has 39 years of consecutive dividend growth. Ben is a stock I already have a substantial position in, so I won't be adding any more myself. But again, if you've been thinking about it, a 21% haircut is kind of nice. Let's go on to BNS Bank of Nova Scotia. Look at this nice 5.59 yield, a 1% beta, the same 21% haircut. It's technically not a dividend aristocrat, and that's because the Canadian government took action during the pandemic and regulated the banks around their dividends to preserve capital. But the reality is, you can see BNS has been paying a dividend and increasing dividends for a very long time, over the past 30 years. The next one on the list is Verizon. It's at a 6.18 yield, a really nice 0.3 beta. It's down about 22% this year. It's not a dividend aristocrat, as it only has 17 years of consecutive dividend growth, but you can see here, Verizon is at its lowest level in the past 5 years. FRT, Federal Realty, is the next one, at a 4.16 yield and a 1.1 beta. It's down around 24% this year. It is a dividend aristocrat with a stellar 54 years of consecutive dividend growth, and FRT is still under the level it was pre-pandemic on average. The next one on the list is Target. It's at a 2.5% yield, a 1.0 beta. It's down around 25% this year. It is a dividend aristocrat and has 53 years of consecutive growth. Home Depot made the list. It's currently at a 2.53% yield, has a beta of 1, and down around 27%. Although not a dividend aristocrat, it has 12 years of consecutive dividend growth. Sherwin-Williams is the next one. It has a 1% yield, 1.1 beta, down around 29%, and has 43 years of consecutive dividend growth. Sherwin-Williams is another one of those pandemic stocks, because if you would have bought it at the end of 2021, you would have paid around $350. That price is currently around $240. So yet another dividend aristocrat that, if you've had on your maybe list, could be near a place where you could add. The next one on the list is 3M. It's currently at a 4.84% yield, has a beta of 1, and is down around 31%. They have a remarkable 63 years of consecutive dividend growth. Now with 3M, you can see a bit of a slow decline over time, but then a rapid drop with a lot of volume and activity just over the last few weeks. So what's going on there? It really centers around this lawsuit with one of their divisions around faulty earplugs. But I have a question for you. Have you ever heard of PFAS or PFAS? These are man-made chemicals that are found in cleaners, textiles, leathers, firefighting foams, and other coatings that are on things like pans that we cook with. Unfortunately, there seems to be a high link to things like liver damage, obesity, and a lot of different cancers. Have you ever seen the movie Dark Waters? If you haven't, I would recommend looking for it on your Netflix or Hulu, because after I watched this movie, I tell you what, I was shook. It is shocking how much these companies knew and how destructive these chemicals are. And if after watching that movie you feel like you want to buy the dip on 3M, go for it. But this is actually the stock that I recently liquidated and have since redistributed. I just think that over the next 10 years, there is going to be a lot of drama around 3M and additional lawsuits that come through. And I just wanted to take that drama out of my portfolio and put it into things that I'm more confident in and better reflect my values. So the next one on the list is T. Rowe Price. It's currently at a 3.86% yield, a 1.3 beta. It's down around 36%. Many folks mentioned Intel, which is currently at an amazing 4.64% yield. It has a 0.6 beta and is down around 41% year to date. And although it is not a dividend aristocrat, it does have a track record of 7 years of consecutive dividend growth. Now, Intel should benefit from the Biden CHIPS Act, but it could take a while for the company to meaningfully capture the value. And the last one on the list is SWK, Stanley Black & Decker, currently at a 3.58% yield, has a 1.3 beta, is down over 50% year to date, but has over 50 years of consecutive dividend growth. This is yet another shocking pandemic stock where if you had purchased it in May of 2021, you would have paid around $223. And today, it's hovering at around $90. So in this list, which are the ones that I am thinking about? Well, I'm thinking about ADP, as it's always been on my list, is recently down and flat for the year, and may be ripe for a bit of a rebound up. I'm long on O Realty Income, and that recent drop does not scare me, so I might be adding more to Realty Income over the next coming weeks. The next one is BNS. That 5.6% yield is very juicy. And although it may go down a little bit more, I'm stacking some additional cash into BNS. And I also like the looks of FRT. A really nice REIT with a very strong balance sheet and a long track record of dividend growth. Which ones will I stay away from? I'll probably not put any more into Target, as I think there's some additional headwinds for retail with inflation and the continued online competition. So for now, I'll just hold my shares of Target. As you know, I completely sold out of 3M, and I already have a lot of Verizon, so I won't be adding more to that position either. And lastly, Stanley Black & Decker. This is a tough one. You know, sometimes great companies go through periods of uncertainty, and managing a business is hard because for a while you couldn't get inventory and warehouses were empty. But just as inventory comes in, the market slows down, and that could cause some additional whiplash for some companies who all of a sudden have a sales problem. So I'm going to keep Stanley Black & Decker on my watch list, as well as Intel and Home Depot. And I might strike if the prices come down even farther. But let me say one last thing. This list is already curated to 15 very strong companies. It's just a matter of doing a little bit of research and figuring out if the stock is down year to date because it's swinging low after the pandemic, or if it's down year to date because there's a fundamental challenge for the business, or if it's down year to date because of investor fatigue or fear. Those are some of the questions you need to be answering as you look at this list and any on your watch list that might be down, in order to figure out which ones you might be able to take advantage of in the short term. Of course, as you know, I'm a long-term investor. So if you are too, when you find a company you believe in and you want to hold them long-term, getting in at a little bit of a discount may just be a good first foot to start off on. So as I mentioned at the beginning, I said I'd reveal something personal. This week, the Queen of England passed away. My circle of family and friends was deeply sorrowful, as both of my parents are from England. So my fact is that I'm a first-generation American and have experienced all of the struggles that comes with that. But I just wanted to say, for anyone watching in the UK, I'm sorry for our collective loss. And now you know that when I get comments from people in Canada or Europe or Australia, I feel a strong kinship with you. Well guys, that's it for today. As always, I encourage you to do your own research, then implement and learn by putting it into practice. As a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I will see you on the flip side.